Opendoor wrapped up Tuesday's session with another telling day of trading. The stock closed at $4.70, up 16 cents or about 3.5% on the day. But as always, the real story is in the journey between the open and the close. The stock ran as high as $5.28 intraday, showing that the appetite to push higher is still alive, but it couldn't hold those levels. Instead, we saw it settle back into the $4.50 to $5 range, which now looks to be the new battleground. Think back just a week ago, those levels were lower. We were talking about $3.50 as a floor and $4 as a ceiling. Today we're talking about $4.50 as a floor and $5 as a ceiling. That is progress. That is how stocks consolidate after massive runs. The levels shift higher, and the base builds. To me, that's bullish behavior, even if the candles look choppy. Let's call it what it is. Volatility is part of the Opendoor story now. But volatility doesn't mean weakness. In fact, the ability to test higher levels, fall back, and then hold new floors is exactly what builds resilience in a stock. The $5 ceiling has been tested multiple times over the past 2 sessions, and each time it gets a little stronger. The $4.50 support is now acting as a kind of magnet, keeping the stock from drifting back toward those old ranges. That's how momentum evolves. It's step by step, floor by floor, ceiling by ceiling. Now, in terms of fundamental news, Tuesday didn't bring a major new development. There was no surprise Fed announcement, no merger headline, no big institutional filing. But what did happen was perhaps more telling. The conversation online continues to shape this stock, and the leadership continues to show they are listening. On X, there was some chatter from real estate professionals pointing out a flaw in Opendoor's current setup. One agent commented that when Opendoor's iBuying service rejects a property, the platform doesn't always provide a good fallback option. If there's no partner agent in that area, the customer can hit a dead end. That's a real pain point, because think about it, someone has already come to Opendoor's platform, already raised their hand to engage, and then the experience can just drop off if the iBuyer funnel doesn't fit. That's lost opportunity. Here's the part that stood out. Shrisha, the acting CEO, responded directly. He acknowledged the issue and admitted it's an area the company needs to work on. That is not the kind of response you get from many CEOs, especially not from an interim one. But it shows 2 things, he's engaged, and he's committed to transparency. And that is something investors should not overlook. Now let's dig into the bigger idea here, because I think this comment opens up an intriguing path for Opendoor's evolution. What if Opendoor developed its own small wing of seller agents? Think of it as a way to plug the gaps when iBuying isn't an option and there isn't a partner agent available. Instead of losing the lead entirely, Opendoor could channel that seller into its own agent service. The opportunity here is clear. It would mean fewer dead ends for customers, higher lead capture rates, and more revenue opportunities. Every inquiry that comes into Opendoor's website would have a potential path forward, whether it fits iBuying, the partner network, or this new direct agent option. That creates a more complete funnel and strengthens Opendoor's position as the go-to platform for selling a home. Of course, there are risks. The most obvious is that by creating their own seller agent wing, Opendoor could start to look more like a traditional brokerage. That could put them in competition with the very partners they rely on, and it could blur the disruptive brand identity they've built as a tech-first company. But maybe the answer isn't to become a full-blown brokerage. Maybe it's about being surgical. Deploy Opendoor's own agents only in markets where coverage is thin. Use them to plug the gaps, not to replace the partner network. And do it in a way that leverages Opendoor's technology and AI advantage, so these agents are more efficient than traditional brokers. This idea actually fits nicely with the broader retail vision we've seen in the shareholder letter Pompliano submitted. That letter called for expanded services, stronger app development, and more ways to monetize the seller funnel. A direct seller agent wing could be one of those ways. It could take Opendoor closer to being the true one-stop shop for homeowners, without fully sacrificing its disruptive DNA. Let's zoom back out. The fundamentals of the bullish case remain strong. The macro backdrop hasn't changed. Powell's signal at Jackson Hole still points toward September rate cuts. That's bullish for housing. Lower mortgage costs mean more transactions, and more transactions mean more business for Opendoor. The retail conviction hasn't changed. Eric Jackson is still out there making noise, still pounding the table with his $82 long-term target. Anthony Pompliano is still pushing the idea of the retail hive mind acting like a decentralized hedge fund. And now we've seen that Hive not only contribute strategic ideas, but also highlight pain points in the platform that leadership is acknowledging. That's a kind of shareholder activism and engagement you don't often see, and it strengthens the story that Opendoor is more than just a ticker, it's a community-driven transformation. Technologically, the pivot to AI is still front and center. Shrisha has made it clear that AI is now a core primitive for Opendoor. Tools like Repair Copilot and Risk AI are proof of concept that the company can build and deploy real, functional AI tools quickly. That makes the business leaner and more scalable. If you add in something like a seller agent wing powered by AI tools, suddenly you're talking about a hybrid model that could scale far faster than traditional brokerages ever could. So when we look at Tuesday's action in the stock, the rally to $5.28, the pullback to $4.70, the ceiling at $5, the floor at $4.50, it all fits into the story of consolidation. The stock is building a new range, and each range is higher than the last. That's bullish. That's momentum evolving in real time. Heading into the rest of the week, the key remains $5. That's the ceiling. If Opendoor can break through it and hold with volume, the next leg higher could come fast. If it stays in the $4.50 to $5 range for a few sessions, that's fine too. It just means the base is solidifying. And in a stock this volatile, base building is exactly what you want to see if you're aiming for higher highs. So my takeaway is this: Tuesday's session showed resilience. It showed that the stock can test higher, fall back, and still close green. It showed that the $5 range is now the battleground, and the $4.50 floor is holding. It showed that leadership is listening to feedback, even when it's critical, and that there are still untapped opportunities to strengthen the business model. The long-term vision remains intact. The short-term consolidation is healthy. The retail conviction is unwavering. And the macro tailwind is lining up. To me, that's a recipe for more upside. Opendoor isn't just surviving the volatility, it's defining it. And as long as the story continues to evolve this way, I believe the rally still has plenty of room to run.